A week ago, US tech stocks sold off hard, and we said that it was just the start. The economic situation is beginning to come to a head. The trillion-dollar wipeout last week has now tripled. Things are getting worse. Over $3 trillion in value are now gone, and volatility is through the roof. And it's likely this sell off isn't done yet. If we look at the charts, we could be heading back to Q3 of 2022, and that's when the S&P collapsed from 4,300 all the way down to 3,600 over multiple weeks of sell-offs. Fear and momentum are dangerous combinations. Everyone is in panic mode now, so it pays to be ultra cautious. We know the end game is higher asset prices. We are in a forever inflation economy, but things can turn deflationary for risk assets in a hurry. And this is what happens when interest rates stay too high for too long. Plus, you have a deadly mix of high valuations. All we needed was a trigger, and we got it from the dismal jobs report. And this could be the start of the slow motion collapse. The US economy is now in real trouble. The payroll reports was disappointing to say the least. Only 114,000 jobs were created in July, and these are the official numbers. It's very likely they will revise it down again. And it doesn't take a genius to see that we are on a downtrend in job creation. To add fuel to the fire, the unemployment rate jumped to 4.3% in July. We are back to October 2021 levels. Hourly earnings also came in soft, rising by only 0.2%. In a nutshell, fewer jobs are being created, more people are unemployed, and less money is being earned. Inflation is still a problem, but the real economy is starting to buckle. Just don't ask Janet Yellen about that. According to her, it's people like you and me. We are the delusional ones. The US economy is exceptional and can't possibly face a collapse in growth.
Take an economy that is performing very well. We've had the fastest recovery from a downturn that we've ever seen, and the fastest recovery of any nation around the globe. The unemployment rate is near a 50-year low. The economy is doing well.
Well, I don't think that's very accurate now. Yellen's always behind the eight ball. Remember transitory inflation? And it's really hilarious when you realize she's a trained economist. Even Wall Street is waking up. They realize that, oh my god, the US economy is in real trouble now. The spiel from the Fed and the US Treasury is just professional BS. This is further proof that the economy is slowing. The Fed should be more worried about the economy than inflation. And this next part is very critical. Washington drama, geopolitical worries, and now we can add a slowing economy to the picture. Bad news is back to being bad news again. For over a year, the world has been upside down. A slowing jobs report sends stocks higher because it signaled a rate cut. Left is right and up is down. Well, all that is going to reverse. The world is now seeing the truth for what it really is. Higher unemployment means a spending crisis, and that is obviously bad for the economy, so stocks are beginning to sell off. It's important to dig deeper beyond the headline jobs number. We might be on the brink of a recession. A big concern is the rise in jobless claims. This has risen to a 32-month high of 2.1 million. You have more people out of work and filing for unemployment. This isn't a sign of a strong economy, it's a sign of a weak economy. People are losing both full-time and their part-time jobs, and this signals the true weakness of the underlying economy, which is very different from the stock market. And now reality is beginning to catch up. Another ominous sign is the collapsing ISM numbers. We know the US has a trade war with China. The plan is to decouple supply chains and get Americans to buy stuff made in the USA. And if that's the case, we should see new orders and a PMI fly up. But the August numbers are out and they have crashed further under 50. That is a sign of contraction and is very recessionary. These are leading indicators. They tell us local and foreign demand for US goods just aren't there. People just don't have money to spend. The longer we stay under 50, the higher the odds of a recession happening. At the end of the day, stock prices are controlled by earnings, and earnings come from the real economy. If more people are unemployed, the less money we have to spend, and that's why we have the figures flashing red today. There's a recessionary indicator we need to know about, and it's called the SUM rule, and it has been 100% accurate since the 1970s. It tracks unemployment. When the 3-month average is 0.5% higher than the past 12 months, a recession will come. The latest 3-month reading is at 4.1%. 12 months ago, it was at 3.6%. So the prophecy has been triggered. If this is foolproof, a recession is on its way. If the US economy contracts, the whole world will be affected. There's no escaping this. The biggest consumer in trouble will hurt every single economy in the world. And it's why we have a global stock sell off today. Everyone believes that the Fed will save the day. After all, Jerome Powell himself has admitted that rate cuts are coming. And that should be good news, right?
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
A cut in September is almost guaranteed. The Fed will lower interest rates and take pressure off the economy. But there's a big elephant in the room, a real fear that everyone has. Is the Federal Reserve cutting rates because inflation has been warned? Or is the real reason because the economy is on the brink? The market now believes a double rate cut is coming in September. Instead of a single 25-point cut, the Fed will drop rates by 50 basis points. The odds of this is more than 70%, which is a big sudden shift in sentiment. In other words, the economy is in trouble and the Fed will panic. Powell will slam rates down to save the economy. And how could he not? If we look at the headlines, we are seeing a bloodbath in layoffs. Intel is going to fire 15,000 workers, their earnings have collapsed, and even government grants can't really bail them out. Margins are just too low for them. Stellantis, the automaker, is trying to buy out US workers. Take the payout, take the money, because sooner or later, we have to fire people. Profits have crashed and employees have to go. And this is Bidenomics for you. Despite the national debt hitting $35 trillion and record deficit spending, the economy is just not responding well. Just because the government borrows tons of money doesn't mean it's heading to Main Street. The average American worker doesn't benefit, the money gets eaten up by big interests. The US deficit is getting progressively worse. The deficit today has reached 6.6% of GDP. But economic growth is 2% at best. Over 4% is being wasted and frittered away. What's going on with the money? If the deficit is this bad without a recession, just imagine how nasty things will get once GDP goes negative. The amount of bonds issued and bailout money will be insane. But we are still being fed the same old narrative by Yellen that everyone is fine and that we are all just paranoid. Nothing to see here. The economy is going fantastic.
Today, the global economy remains resilient, driven in large part by the United States' remarkable economic performance. Instead of faltering, U.S. GDP grew by a robust 3.1% during 2023, and new data from just this morning shows growth of 2.8% in the second quarter of this year, affirming the path we're on to steady growth and declining inflation.
This was during the recent G20 summit. This is crazy. We have the data literally crumbling before our very eyes. But let's pivot back to the stock market. When the Fed cuts interest rates, is it bullish or bearish? It's easy to assume when you bring rates down, stocks fly to the moon. After all, borrowing costs are now cheaper, so companies can expand, people can borrow more money and they can consume. But the Fed is cutting into a weak market. The damage has already been done. We just need to look at the US Treasury 10-year yield. It has dropped to below 3.8%. That's a fantastic collapse, when yields were just only 4.6% back in April. Despite the inflation crisis, despite Yellen selling tons of bonds, investors are piling to long-term bonds. Why? Because this is a flight to safety. The market is preparing for a recession and for stocks to collapse, so they are locking in rates at 3.8% today for the next 10 years. Bigger sell-offs could be coming, and it won't be a surprise if the Fed cuts 25, 50 or even 75 basis points in September. Powell isn't lowering rates because of inflation. He's cutting rates because the economy is on the brink, on the precipice. What happens when the Fed cuts rates? Will stocks head up or come crashing down? This is the big question. According to history, equities tend to still rise by 5% on average 1 year after the first cut. But look at the big drop in 2001 and 2007. After the first rate cut, the economy went into recession, and that was the dot-com bust and the GFC collapse. Stocks got absolutely smashed. They were down easily by 20% in the first year alone. And if we take the data of the layoffs and the bond market, we are likely headed towards a recession or a hard landing. Now, whether this happens really depends on the Fed. If they decide to print money and throw stimulus like back in 2020, then this could be rather shallow. It'll cause another inflation crisis down the road, but it'll help the stock market rebound at least, right? Might even help us avoid a recession. But if Powell decides not to reinflate the bubble, then it's really bad news for stocks and investors. We could see a multi-year stagnation in stock values. This chart is from Goldman Sachs and it maps out the worst case scenario, which is becoming more and more likely. We could see up to 24 months of pain in the S&P. The fall could hit over 15% and it'll take 2 years before we hit back up again. Now, I'm not a soothsayer, but it pays to have this at the back of our mind. If we have a recession this year or next year, and Powell doesn't save the day, asset prices can go absolutely nowhere for years. However, if Biden, Trump, or Kamala puts pressure on Powell and he caves, we could be back in a bull market, right? A bull market, zombified bull market. And those are the other scenarios on the chart. He might slam rates down in a hurry and print trillions in a panic. The worst case scenario isn't good for anyone. The global economy is so connected that a US collapse will affect the whole world. Even China will take a beating as well. Japanese stocks are being crushed to the ground as we speak. 600 billion has been lost, and it is the worst sell-off since 1987's Black Monday. And yes, it could get worse. Valuations today just don't make sense, especially those in technology. And let's not forget the instability in the Middle East, which could erupt into a bigger war. A Trump victory in 2025 could trigger a global trade war as well, and that would most definitely spark a recession. So the black swans, they are circling around, and it's really time to get prepared. But as always, let me know what you think. Is a recession coming this time? And will the Fed write this one out or print trillions of dollars to save the economy? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.